We have a new episode every fourth Monday of the month, providing free educational content so you can be a more informed passive investor. Tonight's webinar is a special edition with a special guest, Damion Lupo, who's going to tell us why the eQRP is a better option than a self-directed IRA. I'm Gary Lipsky, president of Break of Day Capital. Our other host is Kyle Mitchell, managing partner of Limitless Estates. Our companies work together to provide passive investment opportunities for busy people. We focus on acquiring multifamily real estate investments that offer value-add opportunities. We look in growing markets for undermanaged assets to maximize investor returns. A little bit about me. I've been investing in real estate since 2002 and went full-time into real estate in the beginning of 2017 after selling a business I owned. I personally invested passively in over 1,500 units before I started syndicating my own deals, and I still invest passively. Currently, I have 170 units under management with Kyle, and we run a Phoenix meetup together. I also run a few other meetups in Los Angeles as well. I know a bunch of you that are on tonight's webinar have attended some of our meetups before, and if you haven't, we'd love for you to join us in the future. I started investing in real estate in 2002, and it has been a passion of mine for many years before that. I have started a nonprofit for underserved youth, been involved in a business mastermind group, and have run several businesses that gives me that critical business operational experience necessary when you're asset managing a property. Let me turn it over to Kyle and let me tell you a little bit about himself. Kyle?
Thanks, Gary. Thanks, everyone, for hopping on tonight. I am Kyle Mitchell, the managing partner of Limitless Estates. As Gary mentioned, we have 17 million under management, 2 properties in the Phoenix and Tucson markets, and we focus on value-add investments in B2C class areas in the Arizona markets. I'm also the co-host of the weekly real estate podcast, Passive Income Through Multifamily Real Estate, and principal of multifamilymasters.com. We have about 55 chapters nationwide, also a few internationally, and our group is a grassroots effort to educate people on multifamily around the world. And I also host 2 of those, one in Phoenix and one in the LA area. My background before multifamily was in operations and management. I was a regional manager for a golf management company. And basically everything that you do once you close on a property, you manage people, you implement systems, manage the budget, hire, fire people, and manage the manager. So, and right now we are focused on, adding value to people, and we appreciate you being on, and we're going to hand it over to Damion Lupo to take us through his presentation.
Watching, see some of you guys out there, Brian, Ernesto. It's great to have you guys joining us and everybody else. So what we're going to talk about today, I'll give you a little bit of my background and then mostly just give you a lot of content, chance to answer or to ask some questions. And we're going to be talking about something that I wrote a book on a number of years ago called the eQRP book. This is the current book. I'm going to give you a chance to get a copy of this if you'd like at any point. This is the new one that just came out in 2020. And so let's just kind of go right into it here. The first thing I really want to share is the idea that right now everything is moving faster, and it really, if we're going to make decisions with investing, we have to be willing and able to make those decisions in very quickly. One of the examples of something that was life-changing for me was a decision I made about 3 years ago when somebody called me and they said, "Hey, do you want to go to Africa and check out the gorillas?" And I said, "It sounds awesome. I'm in." So it was like 4.5 seconds. It wasn't really like a 45-second thing, but it was kind of a cool experience. This is a silverback gorilla that had just pushed through us and then decided to grab a branch and scared the living crap out of us. So it was kind of fun, and I just wanted to give you guys an example of how powerful decisions how powerful it is to make decisions quickly. And in investing, this is the reason I bring this up. You're going to miss out if you're not willing to make decisions very quickly these days because everything is moving at the speed of light. The other thing that's important with investing is that you have to be willing to commit to something. This is a number many of us have seen over the years from Malcolm Gladwell, and it's the 10,000 hours. 10,000 hours is the beginning of mastery. And there's a couple of things that I've spent 10,000 hours in. One of them was martial arts. I've spent probably 20 to 30,000 hours in this space. This was just a black belt, one of my third degree black belt tests and demos. And the other thing was in real estate investing. I spent a number of years, many years, building up a portfolio like Kyle and Gary. This was my portfolio in 2007, had $20 million in it. It was basically started off with a bunch of houses. Like my doors were individual houses, which is definitely not what I would do now, but that's what I did. And it looked pretty good. It was very exciting. I had Will Smith's car from Bad Boys 2, and I felt pretty good about myself until 2008, and that's when it blew up. And in 2008, I really had an epiphany, and I realized that my net worth and my self-worth were the exact same thing. And when my net worth went from positive 5 million to negative 5 million, I started asking a question who I was and what I was doing if it was just about the money. After I spent a couple years figuring that out and asking better questions like what the heck is true and who am I came up with a different why. And the different why was to break financial bondage. It was to break 1 million people's shackles. And that's what the work that we're doing now and why I wrote the book. It's what this is all about. I'm going to give you guys a chance to understand a tool that you might be able to use both for yourself and for other people. And it's just a really interesting way to approach things that's very different from probably what you've been told and taught over the years. What I would suggest and invite you to think about is that the IRS is probably the most fearful thing in your life if you don't have good information. And what I mean by that is this number here, the 70%, is how much of your money is going to be taken over your lifetime. That's what governments, the IRS especially, is going to take in taxes. And you have to be able to do something different if you're going to make that 70% turn into maybe zero. What I'm going to share with you guys and help you understand is a way to use a tool to make your tax rate go from 70 potentially down to zero. If we're going to do something different, we've got to start by thinking different. And when we think different, we can ultimately invest different. And yes, I'm a big Mac guy because I just think Macs are awesome. So if you don't like Macs, I apologize, but I do. And this is what we're going to talk about. This was a Steve Jobs, Apple type of idea for thinking and investing differently. What we're going to talk about specifically is the eQRP. It's the Enhanced Qualified Retirement Plan. And the E also stands for energy, and it stands for employees as well. We're going to get into that in a minute and help you understand why it's so incredibly valuable and what you might be able to do with it. Effectively, it's the Rolls-Royce of 401ks. And I say that because it's a tool that helps you tap into the $30 trillion in retirement. Now, as of today, and if you're watching this later, it might be a little different, but as of today, there's less than 30 trillion because the market has absolutely melted down. And it was a good example of why we do real estate things, why we do things we can control, because the market's lost. I mean, I saw something that the billionaires, there were like the top 10 billionaires lost $40 billion the first couple of days of this week. And it's because, in reality, we don't really have control of the financial markets, but we can do something different where we control our retirement money and do that, invest in things like real estate. And I'm going to show you guys how to do that and how to do it smart and not get hammered with taxes that are totally optional. So the first thing that most people will say, and this may be what you're saying right now, is why haven't I heard of this? Why haven't I heard of the eQRP? If you listen to podcasts, you probably bumped into it. If you are just new to it and fresh to podcasts, this might be brand new. The reason that you haven't heard of it is because Wall Street's fees and control, and when I say Wall Street, I'm also talking about custodians. The game is for the fees they charge for those fees to come out of your money and to go into their pocket, and it's about them having control of your assets. So that's really why you don't know about it, because there's billions and billions of dollars in marketing that are spent to make sure that you are compliant, that you literally keep your money with them. The eQRP is a totally different approach. It's a checkbook for your retirement money. It allows you to invest today. Basically, if you decide you see a deal and you want to do it at 9 a.m., you can have that thing funded by lunch. There's no transaction fees when you're doing deals. It protects you from lawsuits. And in a lot of places, it's basically you've got a litigation and a lawsuit issue if you walk across the street because somebody's going to sue you for looking at them wrong because you're going to offend them. I mean, it's just reality today that America is full of a lot of lawyers and a lot of people that are suing, And this tool is going to allow you to protect your assets. It also gives you a $50,000 credit line, which can be really useful, and I'll share an experience of why that was so useful back in 2008 in a few minutes. One of the best things about real estate is that you can use debt, and if you use debt in a real estate deal and you use retirement money, you could potentially be paying a ton of taxes. I'm going to show you how to avoid that. And ultimately, we like debt because it allows us to accelerate our returns with real estate. And that's awesome, unless you get taxed. So I'm going to show you how to never get taxed. Okay. Options to invest. Real estate is probably the most common used investment and the most common choice. A lot of folks are investing in global things nowadays, coffee farms, land, different things all over the world. Being the bank where you are lending money is it's a pretty awesome option to be able to use your retirement account money for. You can buy gold, physical gold, something that you can't do with an IRA because only with an eQRP are you actually able to hold the gold physically. And if you're not holding the gold, it's not really truly an asset in my mind, because if you're not holding it, it's maybe out there, maybe not. This is a great way to do that. You can also buy things like Bitcoin, other cryptocurrencies, if that's something of interest to you. A few things are disqualified. Certain people your retirement account money cannot invest with. People like your children and parents are the primary ones that people run into. Basically anybody above or below you in your family tree, anybody to the side, cousins, brothers, they're all going to be fine. You can't buy property that you're going to use, like a vacation home. Although you could buy a vacation home that you were going to use when you retire and just rent it out until then, so that might be an option. The other thing that's pretty common that people ask about is collectibles, rugs, cars. Like you can't buy a collectible car, fix it up, and try to sell it. And the IRS and the government don't want you to buy wine because they're afraid you'll just consume your retirement before you retire. So those are things that you really can't do. Let's go into some examples for the self-directed IRA versus the eQRP. The reason we talk about this is because most people use IRAs and they just don't know any better. This was the best information that they had. And if that's you, that's great that you did something. I'm going to give you better information that is going to potentially allow you to make a better decision. All right, so big differences between the IRAs, self-directed IRAs, and the eQRP. Self-directed IRAs are slow. You've got a custodian involved. They're taxed with UBIT. I'm going to show you an example of that and how brutal that is. And really, you can't put much money in them. I mean, $6,000 a year might sound like a good start, but if you're still doing that 20 years later, you're not going to be rich. You're just going to be old. The eQRP is fast. You can write a check or wire money within minutes whenever you want to, and fund a deal on your time frame, your clock, versus somebody else that drags their feet. And you can have unlimited amounts of debt without tax, which is huge. So that's, again, why we like real estate. Here, you're not going to get taxed on it. In an IRA, you are. And you can put up to $57,000 into it every single year. If you've got a spouse, we're talking over $100,000 that you can put in. So it's a great way to accumulate quite a bit of money versus an IRA, which is really not any great way to accumulate anything other than, I don't know, a lot of fees probably. Let me give you an example of a syndication deal out in Austin, Texas, that one of my colleagues was involved in, and I can show you. I'm going to show you the differences in using an IRA versus eQRP and even some other options. So in this deal, we had a $50 million purchase price. It was a new build, $10 million in cash that came from retirement accounts, and $40 million in debt was thrown on this deal. About 5 years later, the property had produced $5 million in cash flow, and it sold for around $85 million. So in this example, we've got $40 million in profit, which is a pretty awesome deal, and all is good until you realize that the IRAs were going to get taxed. The problem is the UBIT tax, and this can be up to $11 million. UBIT stands for Unrelated Business Income Tax, and it gets triggered because of the unrelated debt financed income. So basically, you've got a bunch of debt, and there's a bunch of profit that was made from that debt, and the IRS says, no, if there's an IRA involved, we're going to throw a tax on here. So basically, if you have a bunch of IRA investors, they made about $29 million, and the eQRP investors would have made $40 million. The eQRP is exempt from this tax, and so the big difference here is IRAs are terrible because they get taxed. eQRPs are exempt. IRA investors can pay up to $11 million. eQRP investors pay nothing. And that's just really a big distinction. And so when you think about it, there's no real good reason why you'd want to use an IRA unless you were stuck with one. Again, the eQRPs are exempt. It's part of the tax code. It's not some funny loophole that Elizabeth Warren's going to throw in and say, hey, we need to tax the wealthy. It's just in black and white. The reason this was put in place was because a lot of pension plans were investing. They were providing funds for developers, and the lobbyists basically said, hey, we don't want to be taxed, so they made the eQRPs and the pensions exempt, which is good for you unless you have an IRA. So another example, we had a client that came to us, actually before they were a client, they came into a live event and they said, hey, we just flipped a house and we're about to close on the sale, but our accountant said we had a problem. And I said, yeah, I can kind of figure what that problem's going to be. But ultimately the deal looked like this. They bought it $150,000, did some rehab. So they were selling it for $300,000. So their profit after everything was about $58,000, which is pretty great. The problem is with their IRA, they were going to pay $20,000 in this tax. And instead of doing that, I said, do you want to get out of that? And they said, yeah. So we spent about 15 minutes going through their stuff, did their application. And in that 15 minutes, we were able to convert them to the eQRP, and that allowed them to keep the entire $58,000. So that 15-minute call was absolutely better than a Geico experience. It's because the eQRP is, again, exempt from UDFI, and that makes a huge bit of difference. I mean, you're talking about the difference between having $38,000 or $58,000. I think pretty much everybody would say $58,000 is better. Okay, so if you already have an investment that you've done, a syndication where you put money in with an IRA, all is not lost, because what we would do is we just do an in-kind rollover where we move the asset from the IRA into the eQRP. We just move it over. And once that's done, there's no UBIT. You get to keep all the money, just like the folks that had that house that they were flipping. All right, so who can do this? The big question is, who's qualified? If you're syndicating deals, if you're self-employed, including like an online business, you have an eBay store, if you're an investor and you manage property, if you're a W-2 employee, this can still work for you. And so a lot of people think, oh, I'm a W-2 and I don't have a business, so I can't do it. There are plenty of ways to do it. I mean, if you opened up a lemonade stand in your front yard and you were in business, you've got a business and you are qualified. And if you have any employees, you can have an eQRP. I'm going to show you how big of a deal that is, and some things changed in Congress about 6 weeks ago. And if you're listening to this later or watching, beginning of 2020, some things changed, and so now the eQRP is absolutely the best and probably the only option for many people. So one of the questions people come up with, they say, well, is the solo 401k something, or is this the solo 401k? And the answer is no, this is not the solo 401k. And the solo 401k is actually problematic because it has lawsuit exposure, meaning if you get sued, your money is not protected. It's not, there's not an unlimited protection like there is with a big 401k that you might be a part of. The other problem is that if you have part-time employees or full-time employees, now or ever, the solo 401ks cannot hold those. The solo 401k is meant for you to always be by yourself and never have a part-time employee. So that becomes a huge problem. I don't know that a solo 401k is a solution. I think it was in the past, and now it's more of a bit of a problem if you have one of those. And further, with the 2020 Secure Act, this is what was put into place around Christmas in 2019. The solo 401ks are not allowed to have employees, like I just said. So if you hire a full-time or even a part-time employee, we're talking 10 hours a week, that blows up a solo 401k. And they're vulnerable to lawsuits. Whereas with an eQRP, you can have full-time employees, part-time employees. You can hire anybody at any time. You're not going to blow anything up. You're not going to be forced to push your solo into an IRA, which is what you'd have to do. And you've got lawsuit protection because ERISA, which is the governing body that created retirement accounts in the early 70s, it actually protects your eQRP. So a huge difference. And I just want to make sure that that's really clear, and we can answer some questions later if you guys have those. That the eQRP is really it's all by itself. It's not a name for anything else. A solo 401k is very different than an eQRP. In 2020, something changed that was very, very cool. And what happened was that it used to be the rules were if you set up a retirement account, you set it up in say 2020, you could only contribute in 2020, or you couldn't set up a plan backwards. So as an example, it's now 2020, and if you realize you made too much money in 2019, you are generally stuck in the past. The law has changed, so you can actually you can create a plan, a retirement plan, an eQRP in 2020 for 2019. So if you just realized you made too much money, like let's say you made 200,000, you could contribute. You could set up a plan now for 2019, contribute 57,000 bucks, and if you have the right type of LLC for your business, your income just went below the threshold to get the 20% deduction. And what that means is that your net income after that 20% deduction is now maybe 115. Bottom line, by using this strategy and the new tax laws, you could save $20,000 instantly. You have to do this before you file your taxes, but this is a pretty big deal. And this option wasn't available until the beginning of 2020. So it allows you to do some tax planning retroactively. So it's kind of planning in reverse. Okay, getting money into an eQRP, you can put almost anything in, from an IRA, 401k, thrift savings plan, which is like a government employee, if you work at the FAA or a lot of military, 403bs and 457s for teachers and firefighters, police, and you can put an unlimited number of them. So there's no limit. You can put 1, 5, 10, 50, doesn't matter. Now, later, it's really open. The only two things that you can't move over are Roth IRAs and inherited IRAs. Everything else can go in. In terms of contributions, you can also put money in from self-employment income, or if you have a W-2 from a company that you own, you can put up to $57,000 per person into it each year. And it can be deferred money or Roth money or both. It's totally up to you. And unlike an IRA, there's no income limit or maximum, meaning you could make $200,000, $300,000, $400,000 and still put money in. With an IRA, you're phased out, and it's challenging. I mean, not to mention that you've got only a $6,000 limit that you can put in anyway. So clearly, eQRP, there are lots of ways to get money into it. And if you have old orphaned 401ks or IRAs, those can all pretty much be rolled in. I mentioned the credit line, which is pretty cool. Back in 2008, when everything melted down and I had lost all the property and had my experience, one of the things that happened was, since I was in real estate at the time, American Express had some losses, and so people like me that had these American Express black cards were having our limits changed. So I was in Costco one time, and I was checking out. I had this giant thing of toilet paper, and at the time, Costco only took American Express, which was fine because American Express black cards, you can charge as much as you want. There's no limit. And when I tried to charge, they said, "I'm sorry, your card's been declined." And I said, "I can buy a jet if I want on this thing." And they said, "Well, sir, today you're not buying toilet paper." And I said, "Well, this sucks." So I called American Express, and they said, "Well, your balance is $11,000." And I said, "Well, yeah, who cares? I have an unlimited limit." And they said, "Your limit is $11,000." So they shut me down, and what I realized was that I was tied to my credit limits, and at that point I was stuck because all my credit cards were being frozen because the market was getting a little weird. One of the nice things about the eQRP is you have a built-in $50,000 credit line that you can use for anything you want at any time. So if you need toilet paper or you want to buy a car or whatever, you always have that $50,000. It's up to half of your account or $50,000, whichever's less. So you write yourself a check and you're in business. It literally takes 5 minutes to fund a loan. You don't have to worry about a bank or American Express trying to limit you. This is a Portuguese saying that I really like, barato se caro, and what it means is that cheap objects can be expensive. One of my favorite guys ever is Einstein, and he said something that I agree with, which is life is just too dang short to argue with stupid people. And I would include the Google voice in that too, because you can get a lot of information about all sorts of things, retirement accounts, investing, from Google, but you have a lot of idiots that are giving information. And unfortunately, it all looks the same because we don't really know the source. So I would suggest that it's better to look for people that have wisdom. Yoda had a lot of wisdom because he had a lot of experience. And when you're learning, it's better to go to guys like Gary and Kyle and learn from them instead of just Googling, because quite frankly, anybody can say anything on the internet, and you want to find people that have been through it, that have actually done it. One of the things that I did after 2008 and lost everything, I said, okay, I'm going to create some rules. I'm going to learn from what happened, and I'm going to have some rules that will allow me to protect me from me. because if you're just going out and making money, it's really hard to stop when the greed glands get swollen. So I created this list of rules and I followed these rules. 3 of the rules are that I only work with, invest with self-responsible people. Like if somebody, I see them as a victim or they're good at blaming things on other people, I simply will not be around them. And I won't invest any more than 5% of my money into anything, because we're always going to be wrong in different ways in different places, and I don't want to be all in on something and then have it blow up and go, oh dang, I missed the black swan. And then the last thing is I won't invest in any bulletproof vest areas. I did that once in Memphis, and when I invested, I bought a multifamily, and about 6 months into the project, I got a call and I was told that somebody stole all the copper out of the project, and I said, well, that's terrible, and that's what we have insurance for. So we went and had it worked out, fought with the insurance company, and ultimately it worked itself out. And then 6 months later, I got another call and I was told that the copper had been stolen again. And I said, well, how could that be? I have an armed guard there. And they said, that's the bigger problem. Somebody killed your guard. And I thought, oh my God. So, I mean, that's a heavy burden. One of the reasons that I don't want to go back to an area that has that type of environment is I don't want to carry somebody else's life on my shoulders again. And one of the values for you guys is that you can learn and you can leverage off of people having gone through those experiences so that you don't have to go through them yourselves. It's brutal to have that type of weight on you, and it's simply, to me, not worth it. So I have rules to protect me from my greed glands. I suggest that you guys all do the same thing, and if you don't have any, I'm more than happy to share mine, and you can create your own from that. And if that helps, I think that'd be a great start, because if I had to do it over again, I would start with some rules. Right now, the biggest concern, probably other than coronavirus, is that millennials and boomers are both worried about running out of money in retirement. And it's a financial concern that really has always been there, and it's going to continue to be there. There's a way to take control of your money so that you're not worried about it. It's not going to be through an IRA or 401k invested in mutual funds. It's going to be doing something different, and you guys are doing something different right now. You're watching this, listening to this, and you're learning and growing from people that are actually doing it. Totally different game plan, and kudos to you for doing it. One of the great things about learning something new is that not only can you use it, you can actually help people, and you get to be a little bit of a superhero by sharing this information with other people. It doesn't really do you any good to do well and be wealthy and then be the only one. I tried that. It didn't really work out because everybody else was still doing their thing and they're still stuck. It's not that much fun. What's fun is helping other people and being successful and really being free together. So what I would do, I would encourage you guys to do, is to share this information. The easiest way to do that is to be able to digitally share things. And if you guys want to text the number 72,000 with the word eQRP, I wrote a report that's basically going to sum up the book. And you can also get a copy of the book, and I'll send it to you. This will allow you to sink your teeth into what this information is, and you can share it with other people. So if you guys want to do that, you can share this with people easily. You can share the report. You can also tell people they can text this number. The word is eQRP, and you can text it to 72,000 to really be able to get the essence of what we're talking about, because it's a lot of information, and sometimes people's heads explode in the middle of this. So if that happened to you and you missed something, this will give you the cliff notes. So that's basically the information that I wanted to share, and I thought if you guys have some questions, I'm happy to answer those. And when you text this, you'll also be able to reach out to me and ask additional questions. You can also find me on LinkedIn if that's of use, and reach out anytime. But Gary and Kyle, if you guys have any questions or anybody wants to put up your hand, I know you can ask some questions right now, and I'm happy to answer those. And whatever you guys want to talk about, happy to dig into it.
Yeah, perfect. Thanks for that, Damion. And we do have a couple questions. If anyone else has questions, please type them in the Q&A. So the first question from Kevin is the $57,000 a year investment cap available regardless of someone's income, or does the amount of money investable is that based on their income?
So the $57,000 a year is new contributions that you're putting in, and it's based on self-employment income. So it's not going to be like if you have a W-2 job, it would not be money you could pull from that job. It would have to be money that you are earning from consulting, or if you flipped a house, or things that are basically going to show up on your Schedule C. And so the 57 is only for new contributions, has nothing to do with how much you can grow. Like you could take 100,000 and turn it into $1 million. Pretty open, like in terms of what you're going to do. No real limits except for the new contributions.
Okay, perfect. And then I do know you already answered this, but if you can answer it again, if I'm already invested in the syndication using my self-directed, is there a solution to reclassify it as an eQRP?
Yeah, I'm glad you brought it up, because that is one of the biggest things that we're doing right now, is getting people out of the UBIT tax by rolling over the assets. It's called an in-kind rollover. So before the asset's sold, we move it. Right now, the laws allow us to do that. We can roll over the asset, and all it is taking it from the custodian into the eQRP, and then once it's there, you're going to send a direction letter to the sponsor of the deal, and they're going to retitle the asset. So totally doable. Do it every day, and it's a great way to go from tax to no tax.
Is there any way to reverse it once a property has sold?
Yeah, there actually might be, and that's a deeper strategy, and we've got some accountants that are fairly confident that they can do that if it's the same year. Now, if you've crossed over December 31st, like if you did it in 2019, it sold, you're probably out of luck. But if it's the same year, it's pretty likely we can still do it.
Okay, perfect. Gary, I know you had a couple of questions.
Yeah, so, whenever I tell anyone about the eQRP, their minds are blown because it's such a useful tool. We have probably our last two deals, 100 investors, and well over 20% have used a self-directed IRA. And when we tell them about the eQRP, they're like, I need to know more. So, a bunch of them do have a W-2. And so what if they have a 401k plan at their work? So how does that work? Can they do that and then have an eQRP, or, tell me a little bit about that.
It's a great question. There's no limit on how many different retirement plans you can have. So you can have a 401k at work. You can have an eQRP for your investments outside of whatever the 401k offers, mutual funds, and absolutely, that's very common to have multiples. And so the only limit is that you have to have some type of business, which is very, very simple to do. And like I said, if you opened up a lemonade stand, you'd probably get arrested in California. But if you did it in your front yard, you could absolutely you could classify that as a business. eBay businesses, online businesses, pretty much anything you can think of classifies, and it allows you to set up an eQRP.
So in that situation, let's just say lemonade stand, right? Not going to make a ton of money. It makes $10,000 a year. Are you now limited to the amount that you can put into your eQRP at that point?
Yeah, the amount that you can make in new contributions into the eQRP is based on the income from that business. The amount you can roll over is unlimited. So it's about qualifying, and then the question is, where's the money coming from? Is it going to be rollover, or is it going to be new contribution, or both? And so you just have to look at the whole situation and decide whether it makes sense. Sometimes it makes sense if you can contribute $20 and then roll your money over, but ultimately it's just a question of somebody's specific situation.
Okay, and then if you are making 10,000, is it based on a percentage of what you can put in for a new contribution?
So there's a formula. So let's say your only income was from your lemonade stand. You can contribute the first $19,500 of income plus an additional 20% of your total income minus your contributions. So the formula basically looks like this. If you made $100,000, you'd be able to contribute somewhere around about $35,000. And so you max out at $57,000 when you make about $160,000 to $170,000 in income. So dollar for dollar, up to $19,500, all of it can go in, and then after that, there's a percentage.
Yeah, perfect. Thank you.
So what if you're a passive investor? You have a full-time job and you're a passive investor. Mm-hmm. Would you create a LLC, invest passively in that, and that's your separate company that you can then put more money into an eQRP, or how would you do that?
Yeah, there's a lot of different ways. I mean, that's one of the options that you could certainly look at doing is having an LLC and having income coming into it. The type of income determines whether you can put new contributions in. In terms of structuring, that's, again, it's case by case. That's one strategy. We're going to look at asset protection. We're going to look at your entire picture of how you're making money. So there's not really a one size fits all, and that's one of the important things that when you're looking out on the internet, for example, a lot of times what's being pitched is, hey, this is good for everybody, and this isn't good for everybody, and neither is an IRA, and you never really know. You have to figure out the structure based on the individual circumstances.
You may have covered this earlier, and I apologize, but what are the fees for eQRP versus a standard self-directed? What are we looking at the differences?
So they vary based on whether you're by yourself or whether you have employees. It depends on. I mean, that's a big factor. And with the IRAs, you can get IRAs for as little as $0. So it's kind of a goofy comparison because, I mean, in terms of when people are looking at fees with IRAs, if you're looking at an IRA, the fee could be $0 or maybe it's $4,000 a year. We've seen fees as high as $4,000 a year because of transactions, because people are getting checks. And so our annual fees are going to be $400, which is 10 times less. And the setup depends on the situation. It's not the same for everybody because we're doing different amounts of work and structuring things. So it might be a couple thousand, it could be several thousand. It just depends on how complex the scenario is. Bottom line is an IRA is 10 times more expensive both in fees and in your UBIT tax. And so there's no good reason, even if you look at a 5 or 10 year period, I mean, you're going to pay 10 to 20 times as much with an IRA guaranteed if you're doing real estate.
Yep. Great. All right. That looks like all the questions. Any other questions from the attendees out there? We'll give it a couple more seconds to pop in.
Damion, I know you addressed this earlier. I have one more question. So, everyone's heard of a self-directed IRA and they've never heard of a lot of people haven't heard of the eQRP. So there's that nervousness around that, like, oh, is this legit? And so how do we get people over that hump?
Well, I mean, bottom line is you've got a letter from the IRS that is it's an approval letter that comes with an eQRP. It's a pretty solid thing to receive, that the IRS has approved something, and that's good. We get that in advance. So we've done the work to go get that. And when you start asking around, what you'll find is that the accountants and the attorneys that are in the real estate industry are familiar with it. Many of them are clients. And so it's really just a question of who you're asking. I mean, there are thousands and thousands of people that have the eQRP in the country, and they have it because they know about it. Most people that don't know about it get whatever they know about. And so as you ask around, you'll just find that more and more people are not only clients, but they're raving enthusiasts because of what it does for them. So I think if you ask the right people, it's kind of like asking your neighbor financial advice. Who knows what you're going to get? Your neighbors, their proximity is easy. You ask the question, but do they have any intelligence or expertise or experience? And the likelihood is probably not. Maybe you just have to find people that have actually read the code. One of the things we find is a lot of CPAs are not familiar with this. And so going to a CPA, going to a firm like Provision, or talking to people like Tom Wheelwright that wrote Tax-Free Wealth, the Robert Kiyosaki Rich Dad Advisory Series, when you talk to them, these are authorities, and they're going to say, yeah, we're familiar, and we have a lot of clients that use this. So if you look at the highest authorities, the people that are the biggest names, they know exactly what's going on, and they know that this is the superior product.
Yeah, thanks for that, because I do tell a lot of people about the benefits, and that is a great way for other people to get them interested about the eQRP and take advantage of it. Because Kyle and I, when we talk to our passive investors, we want them to make the most amount of money possible and keep their money. And this is a tremendous tool, much more powerful tool than the self-directed IRA. So thank you.
Absolutely.
All right, perfect. We have no more questions. Damion, I know people can text you here, 72,000 at eQRP. Any other contact information that you'd like to give out for anyone?
If you want to go check it out, you can go to eqrp.co. And so the eQRP company, eqrp.co, and you can go directly there. It allows you to poke around and learn some more. If you want a copy of the book, you can get it there as well. So I would encourage everybody to go check that out and just do your due diligence. And I think you're going to be very happy with the information you gather up in that process.
Perfect. We really appreciate your time and the value you added here. And that'll be it for tonight's webinar, and we'll see everyone on the next one.
All right. Thanks, everybody.
Thank you.